The best way to describe it is in flux. You obviously follow the earnings reports of banks, and it hasn't been very good for a while, but it's getting better. I think what you're going to find is consolidation and competition, enhanced competition in our marketplace when the economy does recover. Well, in the real estate market, as you know, the residential component has suffered dramatically, and I think we're in probably the latter part of that cycle. I think the commercial real estate market is also showing signs of weakness, and that'll be a drag on banks for a while. As you know, it is a heavily banked market, and I think a lot of the banks that you see that are under stress are really heavily weighted toward real estate. And until those problems resolve themselves, it is going to be a challenge for a while. And that it's going to take some work by the banks that are well capitalized and are liquid, as well as the FDIC assistance. So it's kind of a tough slog for a little while. A lot of jargon in banking, and Texas ratio, the easiest way to think about it is, banks have different types of assets on their books. We hold some investments, merely to invest our money in securities. We have loans, we have branches and other, assets similar to that. Loans are, by far our best earning assets for us, and if you take the non-performing loans that we have on our books, or any bank has on its book, and you compare it to the equity of the bank, and you add to that equity your loan loss provision or the reserves that you've made for it, if your non-performing loans are in excess of